$850 billion. That is not just a line item on a government spreadsheet. It is financial artillery aimed directly at the foundation of the North American housing market. And as of this morning, the hand on the lever belongs to the People's Bank of China. For years, we treated the idea of China dumping US Treasuries as a doomsday scenario, something that only happens in conspiracy theories. But today it is no longer a theory, it is a mathematical certainty. We are witnessing a geopolitical divorce, and this split is going to fundamentally reprice every single asset you own. Here is the reality. The 30-year fixed mortgage rate is about to detach from reality. It is going to skyrocket, and frankly, it doesn't matter what the Federal Reserve does with their short-term rates. If you thought 7% mortgages were painful, you are not ready for what happens when the world's largest foreign creditor decides to walk away from the table. Before we break down exactly how this sell-off destroys your buying power, and, more importantly, how you can build a defensive fortress around your wealth, please make sure you're subscribed to the channel. This is Market Expert. We are tracking this financial war daily, and you cannot afford to miss an update. Also, drop a comment below. Do you trust gold or the dollar right now? Let me know where you stand. To understand the magnitude of this threat, we have to look at a number that most mainstream analysts are ignoring. You'll hear the news say, China holds about $760 billion in US Treasuries. That's the headline number. But that is not the whole story. When you add in the debt of US agencies, entities like Fannie Mae and Freddie Mac, the real exposure is much closer to $850 billion. This is the nuclear leverage Beijing holds over the US economy. For 20 years, this was a symbiotic relationship. China sold us cheap goods, we paid in dollars, and they recycled those dollars back into our debt market. It kept our interest rates artificially low and their currency competitive. It was the greatest trade in history for the American consumer. But the trade war of 2026 has officially broken that cycle. When the US implemented 60% tariffs on Chinese exports, we essentially told them their dollars were no longer welcome. So logically, they stopped buying our debt and started liquidating what they already owned. The latest data confirms they are selling US assets at the fastest pace since 2015. This isn't random. It is a strategic decision to de-dollarize. They are dumping paper promises and using that cash to buy physical gold by the ton. The People's Bank of China has been adding to its gold reserves for 28 consecutive months. But here is why this hurts you. The US government is running a $2 trillion annual deficit. We need to sell billions in bonds every week just to keep the lights on. In the past, China was the guaranteed buyer. Now they are the seller. This creates a massive supply glut. It's basic economics. When there is too much supply of bonds and no buyers, the price of the bond crashes. And in the bond market, when the price drops, the yield, the interest rate, spikes immediately. This is why your mortgage rates are going up even if inflation looks like it's cooling. The market is realizing there is no one left to buy the debt. This dynamic is causing a complete decoupling. The 30-year fixed mortgage tracks the 10-year Treasury yield, not the Fed funds rate. If China's selling pushes the 10-year yield to 6%, mortgage rates mathematically have to hit 9%. The Fed could cut rates tomorrow, but if China dumps $50 billion in bonds, your mortgage rate is still going up. The Fed has lost control. We are entering a period of fiscal dominance, where the supply of debt matters more than monetary policy. China knows this. They know housing is the primary wealth engine for the American middle class. By keeping rates high, they can engineer a recession in the US without firing a single shot. It is asymmetric financial warfare. You cut off their chips, they cut off your cheap credit. The difference is, they can survive without high-end chips for a few years. The US economy cannot survive with 9% mortgages for a few years without a massive collapse. And it's not just residential. Commercial real estate is teetering on the edge. Office towers need to refinance trillions in debt. If rates spike because of foreign selling, that is the final nail in the coffin. We are talking about wiping out trillions in real estate value. The only way to stop this is for the Federal Reserve to turn the money printer back on and buy the bonds themselves. But if they do that, inflation explodes. We would be monetizing the debt of a foreign adversary. This is the trap Beijing has set. We either face a deflationary depression or a hyperinflationary collapse. There is no soft landing. While the housing market bleeds, the plumbing of the banking system is drying up. For the last 2 years, we had a buffer called the reverse repo facility. It was a massive liquidity reservoir holding over $2 trillion in excess cash. It was the shock absorber that allowed the Treasury to issue new debt without breaking the markets. But as of this month, that $2 trillion cushion is gone. It has been drained to zero. This means the easy money is gone. Every dollar the government borrows now must come directly from the existing liquidity in the banking system. And this is happening at the exact same moment China is dumping its $850 billion position. It is a supply shock meeting a liquidity cliff. This puts immense pressure on regional banks. We are watching unrealized losses on bank balance sheets metastasize into a solvency crisis. US banks are currently sitting on over $600 billion in unrealized losses. These are bonds they bought when rates were low, which are now worth 30% or 40% less. As long as they don't have to sell them, they can pretend the losses don't exist. But if depositors get scared, banks are forced to sell at a loss. This is exactly what happened to Silicon Valley Bank. But now it is systemic. Beijing knows the banking system is the Achilles heel of American power. If the banks are broke, they can't lend. If they can't lend, the economy grinds to a halt. So what does this mean for your money? For 40 years, the standard advice was the 60-40 portfolio, 60% stocks, 40% bonds. The idea was that bonds were the safe part of your portfolio. That strategy is dead. In an inflationary debt crisis, stocks and bonds fall together. Bonds are no longer the hedge, they are the source of the risk. Holding a long-term US Treasury bond today isn't investing, it's speculating on geopolitical peace. And looking at the headlines from the South China Sea, peace isn't priced in. Smart capital is leaving the paper system. It's flowing into hard assets, things that cannot be printed and cannot be defaulted on. We are seeing a move toward productive farmland, energy infrastructure, industrial commodities, and of course gold. China is doing this globally. They are buying mines in Africa and farmland in South America. They are trading depreciating dollars for real resources. You need to ask yourself, how much of your net worth is paper versus real? If your wealth is entirely in a bank account or a 401k full of financialized paper, you are vulnerable. You are the counterparty to the government's debt problem. The everything bubble was built on cheap credit. The everything bust will be driven by the repricing of that credit. The billionaire exit involves selling tech stocks and buying land. They are moving down the risk pyramid, getting closer to the base of economic reality. You need to become your own central bank. This means holding reserves that are outside of the banking system. Do not just own a paper claim on gold, like an ETF. In a systemic crisis, that is just a claim on a bank. You want physical possession. China is taking physical delivery of everything. They are draining the vaults of London and New York. This is creating a bifurcation in price. Soon you will see a massive gap between the paper price on TV and the actual price you pay for a physical coin. We are already seeing this in silver. The same dynamic applies to housing. Real estate is a hard asset, but it is heavily financialized. If you have a massive mortgage, it is a liability. Local governments, starved of tax revenue, will come for the homeowner. They will raise property taxes aggressively to fill their budget holes. So even real estate requires a strategy. You have to be more agile than the average investor. Liquidity in a crisis doesn't mean having cash. It means having assets that are universally liquid. Gold is the only asset that is liquid in every country, in every currency, and requires no electricity to transact. That is why the Chinese central bank is buying it. It is their insurance policy. They are building a gold Great Wall to protect their economy. You need to build your own wall around your family. Do not wait for the Federal Reserve to give you the signal. By the time they admit there is a crisis, capital controls will be in place. They will try to lock you into the system with central bank digital currencies. This is the ultimate tool for trapping capital. But the door is still open today. You can still convert fiat currency into tangible assets. The $850 billion sell order from China is just the first domino. It will topple the bond market, then the stock market, and finally the currency itself. We are watching the end of the post-war monetary order. Wealth is never destroyed, it is merely transferred. It is transferring from the hands of the oblivious creditor to the hands of the prepared owner. You have a choice to make. Will you be the creditor who gets paid in worthless paper? Or will you be the owner who holds the assets the world actually needs?